I want to ask you about the concept of investing. The word itself is often used to describe so many different things.
Yeah, I'll cheat a little bit. I'll start with what Warren Buffett says it means, and it's easy to find this one because it's the first quote in the entire book. It's Warren it's a short quote. It's from the 2009 meeting where Warren says, Charlie and I think there is no other kind of investment than a value investment. In other words, we don't know how anybody would invest in a non-value investment. I've always been puzzled by the term value, suggesting it contrasts with growth. Value is getting a lot for the expectable future cash flows in terms of what you're laying out today. Every time somebody characterizes us as value investors, we ask, what other kind could there be?
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Alex Morris. He's the founder of TSOH Investment Research, a long-term focused equity research service with 100% portfolio transparency. In addition, he's the author of Buffett and Munger Unscripted, 3 decades of investment and business insights from Berkshire Hathaway annual shareholder meetings. Alex, how are you? So nice to see you.
I'm doing very good. Thank you for having me. I was just telling you before we started, I was listening to your conversation with Brett Gardner, who wrote about Buffett's early investments, and anybody who is listening to this and interested in this conversation, I'd highly recommend to go listen to that one as well. It's a very insightful discussion.
Well, you both wrote incredible books for various reasons, and obviously we're all fascinated with both Buffett and Munger. And I loved your book, and I told you before we got started that you've done an incredible job going through years and years of transcripts and organizing everything by topic, and then broken down a little bit more and a little bit more. So I think it's an incredible reference for people that have followed both of them for many years. And it's a wonderful place to start for anybody else that wants to know, who are they and why do people care about what they have to say? So it's just an incredible amount of work. So congratulations and thank you for doing it.
Thank you so much. Yeah, it's one of the things I was happy with as it came to a conclusion, because in some ways you're guiding it, but you're also just going wherever the book takes you. And from my read, as I now look back on it, I think it's something that has a really wide audience that it can speak to, which I think is probably true in some ways for, Warren's commentary generally. It can mean something to you at different points over the course of a career if you're just starting out, or if you've been doing it for decades. Even there are still things that you kind of learn over time or read differently. So I hope the book can kind of serve a similarly wide audience of people.
Absolutely loved it, and it brought back a lot of memories of going to the meetings and reading about Buffett and the things that he mentioned at different points in time. So we'll dive into all those details. But you might know that I like to kick off those conversations, if you allow me, with the early days, childhood upbringing, and I want to know how that time shaped you. Maybe if you want to talk about it, your relationship with money and the career path that you chose.
Sure. I mean, well, this in some ways ties into the book, which I spent a long time working on, but figuring out what to put on the pages wasn't that difficult in a lot of ways. It was just putting in a lot of time. And then you get to the end of writing a book, and, you know, normally, or in a lot of cases, people will write a dedication. And for me, it's, 30 words or something, but it's the part of the book that took me the longest to probably to sit down and think about what I truly wanted to say there. And I say that because my background or my upbringing was, I'm incredibly lucky, basically. I have fantastic parents. I have a great sister. My parents, I think, in a lot of ways, especially as I obviously got older, understood who I was, and in some ways let that go the direction that it should, while putting in the guardrails when they needed to, if I ever got out of line. But so growing up, I was, I loved playing sports. I was very competitive. In terms of business things specifically, there wasn't too much in the early days. I was thinking of one example as I was kind of prepping for this that came to mind was there was an elementary school auction type of thing, and you could put products into the auction basically to get funding for other parts of the auction. And I had the idea of putting my bike in or something, but then having an excess of funds that nobody else could compete with to then acquire things back on the cheap. So maybe I had some business insights there. As I got a bit older and got to the point where I was going to go to college, I really didn't have a strong sense for what I was going to do at that point in time. My dad's a plumber, so I kind of just leaned towards building construction as a starting point. And after a handful of years at school, I just kind of realized that wasn't what I wanted to do going forward. Around that same time, I stumbled across the Berkshire shareholder letters and kind of got very interested in that along with a buddy. And we actually drove to the Berkshire meeting that year, which we were going from Gainesville, Florida. So it was a long drive both ways, and we were college kids with no money. So you can imagine sleeping conditions and the like were not five-star hotels, to say the least. But so I had a fascination with that at that point in time. I also started a business with a couple buddies in college as well, which you can effectively think as StubHub for student tickets, primarily to football games, because there were basically different allocations of the general public's tickets and then student tickets. And we tried to create a platform around that. So learned a lot of lessons there. It was not particularly successful, but it also was kind of an earlier sign of my interest in business. So as I got out of school, and around that same time, I started writing to try to learn more and try to build a name for myself a little bit, which thankfully has kind of blossomed over time into what I do now. But when I first got out of school, I went and worked for a small RIA in Jacksonville, Florida. Did that for about 5 years, and then went back and got my MBA in CFA. Then I moved to a larger RIA in Savannah, Georgia. Did that for about 5 years as well. So, call it 10 years total. But I was also writing along that time period as well. And that eventually led to the decision to launch TSOH Investment Research in 2021. So, yeah, it's really just been an ongoing fascination with business and investing, and periodically stopping and looking back and going, man, I was really not that smart 5 years ago. I hope I don't say the same thing 5 years from now, but it seems to keep happening in some capacity.
It's a very humbling pursuit, and I think you have to
Yes.
be a student. And this is image of a student showing up to the teacher, and I have the teacup story. How if the cup is full, you can't put anything in. And I think in investments, if you go in and you say, "I know everything," it can get you in trouble. And the cup has to be not so full most of the time, so you have room for new discoveries. Even reading your book, a lot of it I've heard before, but as you said before we got started, I'm reading it as a different person because I've been doing this for 20 years, right? So I'm looking at it from my own experience and my own perspective and my own mistakes and successes, but it's very, very different. I want to ask you, Alex, about the moment when you discovered Buffett and Munger. How did that happen? And I know they played a huge role in your life, but do you remember how that happened? Somebody gave you the letter, somebody mentioned it to you. How did that happen?
It's funny. I've thought back on this. I don't. I need to ask my buddy from that time, my buddy Brian, how this happened exactly. But As I remember it, we somehow just stumbled across it, and I can specifically remember one summer in particular where we basically went to the library at the University of Florida every weekday, as far as I remember, and we would just sit there for hours, just doing very basic kind of trying to analyze businesses and looking at what Coca-Cola is and reading the letters and that kind of stuff. But I don't remember exactly how it first became exposed to me. But I know once I first saw it that there was no turning back.
There was something different about Buffett and Munger than anybody else probably. And to me, it was the book One Up on Wall Street by Peter Lynch. I was a student and I was taking all kinds of courses. I mean, I loved learning, but I couldn't put it all together and figure out how I'm going to use it, kind of like you. And then that book by Peter Lynch, where he says that stocks are small pieces of businesses, such a simple statement, but it hit me. And I realized it doesn't matter if I have millions of dollars or $100, I can become a shareholder of some of the greatest businesses out there. They're publicly traded. And here I
That
am.
was a that was a book that for me as well was hugely important. And I think back on it now when people ask me a lot of times, like, how do I start doing this? And I think in some ways you can go down the misguided route of thinking that it's, oh, go pick up, valuation by McKinsey and learn
Yeah.
formulas and do that. But it's really just like you. It's Peter Lynch and Warren Buffett and a narrative driven qualitative form of investing that obviously both pieces are hugely important, right? But it's an introduction to thinking about the topic. And that is part of the mindset that, going back to the first question, I think I did have when I was younger. I was always fascinated by the idea of, why did McDonald's decide to build a store right there? They have one 4 miles the other direction and 6 miles. How do they actually think about that? And what does that mean for competitive dynamics in this small area? And what do the economics look like for, those things were maybe not in terms like that, but those were things that were always fascinating to me in terms of thinking about people doing those things and what happens as you do them.
It's interesting you bring it up. The picture that I have is that, there are all kinds of businesses around us. And I will not start all of them. I know that. And I'd like to be an investor, a partner. I think this is ownership mindset, kind of. And if you walk around and you walk up to a gas station, you say, hey, I'd like to own 10% of your business. They'll probably send you home. They say, no, it's for my son, my daughter, or somebody that's already working with me. But the public market in stocks, they don't ask questions. You want to buy a few shares, you can buy a few shares. You want to hold them for 2 days, you hold them for 2 days. You want to hold them for the rest of your life, you can do that. So that's what really appealed to me. And what appealed to me, especially when I was 20, was that the market doesn't care if you're young, you're old, what's your gender, where you're from. The market doesn't care. And Buffett reminds us that the stock itself doesn't care that you own it. I think that's the best part. I want to ask you about the concept of investing. The word itself is often used to describe so many different things. So tell me how you think about investing. Specifically, you write in the book, you have lots about value investing. What does it mean and why it makes sense?
Yeah, I'll cheat a little bit. I'll start with what Warren Buffett says it means, and it's easy to find this one because it's the first quote in the entire book. It's Warren it's a short quote. It's from the 2009 meeting where Warren says, Charlie and I think there is no other kind of investment than a value investment. In other words, we don't know how anybody would invest in a non-value investment. We've always been puzzled by the term value, suggesting it contrasts with growth. Value is getting a lot for the expectable future cash flows in terms of what you're laying out today. Every time somebody characterizes us as value investors, we ask what other kind could there be. I think that encapsulates it very well in terms of just thinking about what you're buying, and to the example you gave, right? Not thinking about a stock, thinking about buying a portion of a gas station or an apartment complex or whatever it may be, and truly being an owner. What are you now thinking about in terms of the inputs and outputs of cash? What are you thinking about in terms of potential changes in competitive dynamics or, macro factors like inflation? How does that impact the ownership of that enterprise? And then how do you then relate that to what you paid for that ownership position in the business? And again, like a lot of things in investing, I think that you can get overwhelmed by the numbers in terms of what that means, but there's also a way to understand it, or at least to think about it, that is very elementary and could be understood by just about anybody as long as they had kind of the proper framing or mindset in terms of thinking about that question, which for someone like you or I, we're lucky to have been. We got we got the bug from people who taught us the right message. So yeah, that's generally how I think about what it means, and then obviously the application from there can go down a lot of different rabbit holes.
So to me, what really spoke to me, and going back to what I mentioned, is it's ownership of businesses. I'd like to own businesses. Why would I like to own businesses? Because they produce income. So it's really ownership of income producing assets. And you mentioned real estate and other things. The part that spoke to me is the businesses. I know how they can scale and grow, and the fact that I can piggyback on somebody else's idea, somebody else's work, by providing capital for this business to flourish. And the minute you shift that from just this, ticker and the price and daily volatility to actual ownership, I think something changes. The other thing that you touched on that I really like is the value and the price. And I feel like we understand the two concepts everywhere except when we try to invest. I generalize here, but if you talk to people about value and price and you go grocery shopping like I did with my grandma, she had an idea how much the egg or the tomatoes worth to her. And if somebody was trying to charge twice as much, she would say no. So the value and the price, it's we know it. Then we go to the stock market and all our natural reflexes that we've developed are gone. And somehow we're chasing stocks that are moving up because they're moving up. And we forget to even ask, how much is this worth to me? How much income does it produce? How much dividend it pays? And what it really represents in terms of ownership. So that's, to me, fascinating how we somehow get completely lost once it comes to stock investing. And it takes a lot to get your bearings back.
Yeah, absolutely.
I want to ask you about some concepts that you bring up early in the book. You talk about time horizons, risk, and volatility, and they're all somehow connected. How does Buffett and Munger think about those?
I think the answer is nuanced. I think there is a component, and it speaks to something that Brett said in your conversation with him that I think is very important in terms of thinking about how Warren looks at companies, particularly wholly owned businesses, but also in public equities. This question of capital allocation and the certainty of the cash flows basically coming back to the owners or being used intelligently, at least, or effectively, as opposed to being misused in some way. I think Brett kind of explicitly lays out there that that was a lesson that he picked up early in his career, even when paying very low prices by conventional standards. Mm-hmm. To the extent that that part of the equation goes awry, it can lead to outcomes that are not good. So I think you see that in Berkshire in terms of the way the types of businesses that they have acquired over time. You see it, and I discuss it in the book as well, the structure of management compensation and how they incentivize actions that are in line with that goal. You see it in public equities as well. Notable example being something like PetroChina in the early 2000s, or I'd say the same for, I think IBM and Apple both had a part of that certainly played in the way that Buffett was thinking about those investments, this question of what will they do with the capital. So I think that's a huge part of it. And then at the same time, I think there's the part of it that we all kind of understand more from what he said over time about companies like Coca-Cola or American Express, this question of enduring franchises and enduring, sustainable competitive advantages at certain businesses. So it's those, in my mind, it's those two ideas tied together in a way that, you can look at Coca-Cola when he decided to invest. It followed a decade where Coca-Cola had done very poorly on that first part of what I just discussed. And I'm sure Warren was watching it closely, and the changes that were underway, including in terms of management, were probably extremely instrumental in terms of his decision to then go out and make a significant investment in the company. So I think that probably highlights in some ways how important of a variable that is to him as he considers, the broader mosaic of a potential investment or a potential business purchase.
It's a fascinating point because you have an asset that produces income, cash at the end of the year. And then as a shareholder, unless it's paid out, I don't have it. So something is being done with it. And it's very interesting to watch what's being done. And you bridge that idea with the price. So you paid such a low price, let's say, in this example that Brad had from the early days of Buffett's investment history. The price might be very, very low. But if the management is not doing the right thing with the capital and the cash that's accumulating, you might be still in trouble. And I think that's a huge, huge lesson. And obviously we're looking for the opposite, right? We want a business that doesn't need a lot of capital, and if they do use it, they get really high returns. There are concepts in your book like risk, volatility, time horizon. I bring it up because I work with families that have an open-ended, infinite investment horizon, affluent families, multi-generational wealth. And when I bring up those concepts of a time horizon or risk or volatility that Buffett and Munger talk about, I realize how those words mean different things to different people. Even when they say I have a long-term time horizon, I want to ask, what do you mean by that? And some people say it's 6 months. For me, it's not long-term. And when you say risk, for me, risk is permanent loss of capital. I made a bad investment and there's no way I'll get the money back. And I have to accept that it's a 50% loss, and I walk away, right? And obviously that's something I'm very aware of. I pay attention to that. And then volatility, it creates opportunities. Imagine a perfect market in the sense that every single day value equals price. This market somehow exactly knows how to price businesses. Then yes, you would still benefit because you buy incredible businesses, but you wouldn't have the advantage that you and I can have, or Buffett has had, when people panic, the fear and greed idea, and you can go in and buy. Can you share some thoughts about it from what you've read from the transcripts and the meetings?
Yeah, I mean, just one example that kind of came to mind as you were saying that, and it gets to this idea of time horizons but also risk and position sizing and framing risk. It's something I think about a lot more and more than I used to is understanding. It applies at an individual level as well, but it certainly applies to Berkshire too. Understanding cash flow dynamics of a business or an entity and thinking about how that then factors into investment decisions, basically position sizing, and how that allows you to think about things in the fullness of time through a slightly different lens than, if you're a retiree who's 7 years old and has X number of dollars and is going to start, taking hopefully a small percentage out of that every year to fund your lifestyle. The thought process on, something like Berkshire, which owned nearly 40% of their equity book was in Coke in the late 90s. The thought process that they could have, and I think did have at that point in time, relative to how the other person in this example would need to think about that. Just a really interesting part of the game that, gets away from the black and white of, quote unquote, right decisions and provides the needed context for thinking about how these things are, there's broader considerations at play, basically. There are limits to where that's intelligent, right? And I think you see it to some extent where something like Coca-Cola, you fast forward to the 2006 meeting, and I think I have the quote here. You fast forward to the 2006 meeting, and Warren explicitly says, you can definitely fault me for not selling the stock. It's a wonderful business, but clearly at 50 times earnings, it was a silly price. I think there were a couple factors at play there that aren't just the ones I'm speaking about, but I think it is part of the thought process to now look back at a position that, 30 years down the road, more than 30 years down the road, they haven't bought or sold a single share since the last time they were active in the stock, and it's gone from, call it 40% of the equity book to something like 5% of the equity book. And the position hasn't done great over that period, but that isn't solely attributable to the underperformance or the performance of the position. It speaks to the cash flow dynamics that he was seeing. And again, I just think it's clearly tied to this question of risk, which has other factors involved, time horizons, etc. So it's an interesting part of investing, and as you're saying explicitly, it also, when you talk to people and start digging into what these terms mean to them, it's a really important part of the thought process that kind of forms a broader investment philosophy and an approach to kind of allocating a portfolio, basically.
You're touching on so many interesting things. When I was listening to you, I was thinking how I have this idea when I invest, I want to be the least wrong. And I think people go into investing thinking, I'm going to be right, and I'm going to prove everybody that they're wrong. I think it's very humbling if you do it over a long period of time, and especially if you manage other people's money. I think it's a huge responsibility that you're trying to be the least wrong, right? And position sizing is one of the elements. I always go in and say, I've done my research, I think I know enough, and then the position sizing is something that's a movable target. To me, the way I look at it, and you brought up some labels before, value and growth. When people want to know, I say I'm a value buyer and a growth holder. I want to get a deal when I buy, but I'm willing to stay when the business recovers and shows continued growth and improvement, because I feel like you would be leaving money on the table if you exited just because it reached a price target. By the way, I dropped the idea of price targets. Wall Street in general is obsessed with price targets. I don't know how you feel about it, but I feel like I just don't know how good the story can get. And I had Chris Mayer on the show. We talked about it, how we just don't know if you bought the right thing at the right price and it's reinvesting in the business and doing the right thing and entering new markets and launching new product lines. I just don't know how good it's going to get, right? I mean, nobody
Absolutely.
knew how good Berkshire itself or Apple. By the way, none of the stocks we mentioned here are any endorsement or recommendation. Do your own research. I think that's obvious, but that's fascinating to me how we think about it. And
No, that's real quick. I think it's something I discussed in my fourth quarter letter at TSOH Investment Research, thinking about, I've owned Netflix for the last couple of years, and just thinking about the journey from, I mean, you could start before the stock reached the lows in 2022, but thinking about the journey over the last 3 years, and just on a continuum of investors, and one end being never sell. I like this business. I think this company is going to be the winner in a very, very large market, and I'm just going to hold it through thick and thin. And then at the other end of the spectrum being what I would call a pure form of value investing, where theoretically you're waking up each morning and you have an Excel document or something, and there's an expected IRR from a given price, which obviously implies some sort of price target or intrinsic value estimate. You update that every day, and as prices move, you adjust weightings to account for what has happened previously. And there's something intellectually honest and pure about that. And like yourself, I personally lean much more towards the first form of investing, while still having a lot of respect for the second form of investing and the underlying logic of it all. But there are components of these things that I don't know what you want to call that part, that little extra that you're adding to the extent that you do calculate a price, right? You're adding a little extra that falls into the category of faith to some extent, unquantifiable value. There's something there, but I also think there's ample evidence, if you look at a broad number of examples across many industries, that you need to be very, very thoughtful about, if you come to the conclusion that you're dealing with a very good management team with sustainable competitive advantages in a business that's very large and likely to get quite a bit larger, how do you then think about what value means there? In my mind, if you're looking at a 3-year forward multiple or a next 12-month multiple and going, that deserves 5 turns or a 20% premium, or however you want to frame it relative to the average business, I personally question whether or not that is going to be a strategy that works well over time. I know it's a strategy that will lead to you not continuing to own those businesses. So it's part of some of this has to be decided at a philosophical level in terms of what game do you want to be playing. And like yourself, my mindset has shifted over time from a silly way of thinking as right approach, wrong approach, more to what are the trade-offs inherent in any given approach? What are the risks that you're willing to incur that are going to be a natural outcome of the game that you decide to play? And I think when you think about it that way, it helps you to make these decisions a little bit more clearly.
I have so many thoughts. I'm looking for the best word to describe it. And speaking of that upside, and you talk about valuation, the price you're going to pay, I'll come back to it in a second, but let's call it uncertainty. But to me, the word uncertainty, first reaction people have, it's I don't want uncertainty. But there are all kinds of uncertainty, right? There's uncertainty, I'm not so sure if I can afford a meal tonight. That's horrible uncertainty. And there's uncertainty where you don't know what the upside of something is, right? So you go to university, you get a degree, and there's this huge promise, what will happen? You don't know. Are you going to become the CEO of a company, or are you going to start your own business, or are you going to become, I don't know, a politician, whatever it is. But it's open-ended. And with stocks, it's the same. There are companies that are on the brink of survival. They can't make payments on their debt at one end. And there are companies where they're on the brink of discovering something new, launching a new product, entering a new market, finding a new audience, and on and on and on. And this is the kind of uncertainty that I'm willing to accept. You can call it a positive uncertainty. The other thing you mentioned about the position size thing, I didn't want to forget about it. Chris Bloomstrand wrote a beautiful note on for your book, and he was a guest on the podcast, and I talked to him about how it was a handful of businesses that made a difference for Buffett. And it's really fascinating to look back and realize you can almost count them, right? The ones that really made a difference. And I want to bring up Aswav Damodaran, a valuation expert, who was on the show and talked about the life cycle of a business, which really added a whole dimension to the valuation question for me. Because we look at businesses and we say that's a low multiple, that's a high multiple. But it's a great reminder to realize that you might be buying the same business you owned 10 years ago, but it's at a different stage of its life, right? It used to grow double digits. It's growing mid-single digits now. Now your valuations and your expectations have to adjust. And I think that's something that we sometimes forget.
Yeah, absolutely. I mean, the game it's a constant evolution, and at the same time, I'm thinking of a specific example that came to mind as you were saying that, Warren, discussing the history of U.S. auto insurance, and at the end of a long discussion about how it's changed over time, he concludes with, it's funny to think that over the course of it's been decades, it's literally been decades, and I guess by his definition, he would say Progressive and Geico objectively had a better product than some of the things that preceded them. And he goes, but if you look back after all this time, we collectively account for like 20% of the market. It took us decades to go from 0 to 20. And it's just funny to think how change impacts different industries and different companies in unique ways. And your response, again, I think it comes back to what I was saying before in terms of how Warren thinks about businesses and why he is particularly fond of situations where growth, to the extent that it requires investment, is something that I think he is, generally speaking, somewhat not attracted to. He's much, unless there's a very high degree of certainty on the return that will come from that investment. Think the railroad or the utilities, right? I think he's much more comfortable in situations, particularly if he can get the growth without putting up the capital, like a See's Candy. But I think he's much more attracted to situations where he has certainty on the duration of those outflows and maybe a small amount of growth with not a lot of incremental capital required to get it, and then having that money come back to him for his allocation. I mean, certainly more so 30 years ago when the opportunity set was a lot larger than it is currently given their size. But I think that's greatly informed how he's thought about change, how he's thought about growth, and it's certainly hard to knock the outcomes that he's had as a result of thinking that way, right? And you have a very prominent example right now of something at the other end of the spectrum with what's going on with the mega cap tech companies and the massive capex ramp. And it's just very interesting to watch that at a time where you have, at least for me, as I've been working through the book, obviously, and talking about it a lot, you have a very different example of what to look for in a business that's attractive and what to look for in an investment that's attractive. And both have their own, positives and negatives, right? It's just interesting to think about what games you decide to play and what risks you are then incurring as you play them.
I think the big lesson for me is that change is the only constant. And I remember, 20 some years ago, some of the stocks we were looking at, a lot of them are no longer, they've been acquired, they're gone. And when we look at the largest companies today and the largest companies 10 or 20 or 50 years ago, they've changed much more than we're willing to admit and accept. So when we look at the allegedly obvious winners of today, I think it's again very humbling to remember that there were some winners before that are no longer. GE was the largest company for many, many years. And I don't remember anybody bringing up GE to me in any context other than, look what happened to them. So there are moments when the winners have to be really paying attention, because the danger can come from places that will disrupt the industry in ways that they have not imagined. And the history of the markets is littered with stories like that.
Yeah, I think real quick, I believe the book's called Power Failure, if I'm not mistaken, which is about GE. And it's a fascinating story to read through the lens of particularly as they get into the accounting for and the incentives behind something like selling, jet engines or things like that. And obviously, long life cycle of the sale and service contracts and all that. It's a really interesting read in terms of there were other dynamics at play in terms of competition and other things, but it's really interesting to read that through the lens of, again, a lot of the things that Warren and Charlie have talked about for decades, thinking about incentives and how people are compensated, and is that truly, truly aligned with the interest of the owner of the business? And those things are at times they're messier and a bit less clear than what it might seem from a kind of elementary analysis of those factors. So it's just really interesting to read it in that light.
Surprisingly, there are fewer books about failures than about successes. I don't know if they sell not as well, I don't know. And it's not as much fun to talk about it. But the truth is, as you pointed out, we can learn a lot from those failures. And if you're a business owner, as I see myself as a stock investor for families, I have to take into account that if we hold something for a long period of time, things will change. And I do want to imagine what could go wrong. And if it does, are we going to be still okay? I think that's something worth considering. Alex, I want to ask you about interest rates. And there's a big part of the book that talks about interest rates. And it's something that, we talk about specific businesses so far, capital allocation, and so on. But interest rates set the cost of money, which is very important. And I'm curious how Buffett and Munger look at it from the studies you've done, thinking about influence on valuations and the whole investment process. And we've seen some dramatic policy shifts in the last 5 years, going all the way to zero, all the way back up, and somewhere in between right now. And it is having an impact on consumers, businesses, and even government borrowing and deficits.
Yeah, certainly. I just pulled the quote from page 348 of the book where Warren says interest rates basically are to the value of assets what gravity is to matter. So I think that captures it pretty well. There are portions throughout the book, which I don't have on me, where they also discuss how interest rates tie into how they then think about discount rates or required rates of return. And again, people can pull the quote so they can have exactly what they said, but I think the gist of it is they're reticent to go below a certain number, even as interest rates move down significantly. I believe they've said something like 10% is a number that even if interest rates are at 1 or 2%, they wouldn't want to go too far below like a 10% hurdle. And then, but beyond that, at more what we used to call normal numbers, it would I think it'd be a spread like something around, call it 5 percentage points, maybe slightly higher than that. And again, I think they to some extent have quantified it, so that's in the book. But yeah, it's the basis for thinking about opportunity costs, and it's the basis for thinking about the value of money. And I think that is, it's funny, it kind of ties into the last conversation as you think about what does business quality mean, particularly over long periods of time. I've come around a lot more to the view that the quality of the management team is a factor that hugely influences that outcome of the business quality. I mean, there's probably no more prominent example than Berkshire itself, where Warren has turned it into something that's worth north of $1 trillion, and it started out from a business that was destined for failure. And that speaks to the importance of the role that he played. But there's numerous other examples like that, both positive and negative. And part of his ability to do that has been an understanding of the opportunity set that he had available to him, which starts with an understanding of the value of the capital as it comes in, and then the various options to then go out and to invest those funds, whether it be wholly owned businesses or publicly traded securities or repurchases, whatever it may be. He has obviously a great understanding of how to weigh those various options, or to let it sit in cash and equivalents as he's doing to some extent currently. So I think that understanding, and also not getting obsessed about the quantification of that understanding, right? And it's something that comes up in the book fairly frequently, this idea of cost of capital or CAPM and things like that. And their response is basically that knowing the specific number is a fool's errand, and it doesn't do anything to actually improve your ability to make thoughtful decisions outside of setting the markers that people can then work around to give you the answer they want, right? So
Yeah.
they've, as with many things, they've moved past topics that are a bit more philosophical and somewhat irrelevant to the actual application of the question, and moved to a more thoughtful question, which is, what are opportunity cost? What is our opportunity set here with capital? And again, it's like so many things in the book. It's an idea that when you sit back and think about it, it's so obvious, and it's something that you may not always understand across a wide variety of topics, by the way, without having really sat and thought about it. It helps to have someone explain it to you or two people explain it to you who are geniuses. I guess that really helps. But it's one of the many things that kind of comes out in the book.
Interest rates are just a fascinating phenomenon to me because, I mean, on so many levels. First of all, that it's somebody decides it, somebody sets it, right? So we have a free market. I don't know how much a pair of Nikes should sell for. And Nike doesn't know until they list it and they realize nobody bought a single pair. Then either it's the wrong model or the price is wrong. And then you go and look for the right price. It's a price discovery system. With interest rates, at least the short-term ones, we have a body, an institution that sets the rates. But the market is the market. And even today, you can see that the 1-year treasury and the 10-year treasury is dancing to its own music. You know, there are actual real buyers and sellers that decide how much money should cost. And we had this phenomenon of zero interest rates, which I think it's one for the books. I don't know if we'll ever go back there. Who knows? No idea. But when it costs nothing to take money from somebody, some silly things can happen. So I think it's very refreshing to have some sort of interest rates. I don't know what the normal healthy level is these days, but at least not zero. I think it creates a bit of a hurdle for all of us. But then you talked about kind of an individual investor's personal hurdle, right? So the rates can be zero, but you personally expect that you're not going to go into an investment unless it can deliver something. You don't know for sure. There's nothing certain about it, but at least you go in with a certain hurdle rate and you say, I will not participate unless there's an opportunity to earn this much. I think that's a great discipline to have, no matter.
Real quick, I think it's worthwhile to add to discussion, just because you brought it up about zero interest rates. Charlie's answer after Warren mentioned interest rates basically are the value of the assets, but gravity is to matter. Charlie's response as they talked about what had happened and how basically economists would have predicted that this couldn't happen effectively. Charlie said yes, and the professional economists, of course, have been very surprised by what's happened. It reminds me of what Churchill said about one of his political rivals. He said he was a very modest man and he had a great deal to be modest about. That's exactly what happened with the professional economists. They were so confident about everything, and it turns out that the world is more complicated than they thought. So it's
very true.
yeah. I mean, it speaks to a lot of things in the world or in macro and other stuff in my mind, which is less so predicting the tides and ensuring that you're in a position to ride the waves and not drown. And that's about as good as you can do. But again, I think to the extent that you believe Warren and Charlie, that's how they've thought about these things for a long time and how they've thought about making investment decisions. And again, it's managed to work out for them. I think we could say reasonably well. That's probably fair.
They navigated all kinds of levels of interest rates over the last 70 years. I'm losing count, but it's been pretty remarkable. Some double-digit interest rates at some point and all the way to zero. It's been a wide range. And I'll ask you about inflation in a second, but it's been an incredible period for them to study and see and observe and think about. You brought up something that I don't want to miss. You talk about people running the businesses. And I find it fascinating, and I definitely pay a lot of attention to that. You might have an incredible business, but it matters who is running it, what the incentives are like, how do they think about the business. And I think it gets harder and harder these days to find people that are truly thinking long-term about the business, not just the 2-3 years. They'll stick around until the options vest and they can move on to the next opportunity. Talk to me more about the qualities that Buffett and Munger look for when it comes to people running those businesses.
Yeah, I think they're, on one level, there's the pretty straightforward things like people who are honest and able and have an alignment of interests. I think where it gets a bit more detailed, and I spoke to it to some extent here already, is the idea of what are the actual incentives and how do you how do you encourage and pay for behavior that is aligned with the outcomes that you actually want as the owner? I mean, there's various facets to this. I mean, I think one prominent example is at Geico when they acquired the remaining, I believe, 51% of the business that they didn't own
Mm-hmm.
in '95, and I think over the next couple of years, there are specific business examples that speak to this in terms of the managers to some extent were compensated or were judged by the market on, a sensible metric like net income, right? The problem is that for Geico to bring on new policies in force, which had a positive MPV, or something that they should do, they required a hit in year one from the combination of higher advertising expenses potentially, but also the difference in underwriting that you see on a year one customer versus seasoned business. So they were able to, once they bought the company, to tweak the incentives in a way to no longer worry about something that, while optically bad for the business, was objectively the right decision in the fullness of time. And I've written about this before at TSOH. You see a clear inflection in terms of the growth rates at Geico as they come out of that period where the incentives are changed. And again, it's not a knock against the people running the business. They were doing what they were paid to do, or what they were
Mm-hmm.
effectively told to do in terms of their incentive structure. I think another very prominent example of that Berkshire talks about a lot is, all these other activities that CEOs or other C-suite, employees of a company have to deal with as part of running a public company.
Mm-hmm.
I laugh sometimes thinking about, I used to own Comcast, and there was a period of time where I think they were going to investor conferences like more than once a month. And I was just thinking to myself, how could this possibly be necessary that someone from Comcast needs to be talking about the business, every 3 weeks? I think hopefully someone can sufficiently explain how the business is doing, even if we just talk, God forbid, once every 3 months. That should be enough to talk about how the business is evolving over time. But there's a number of things like that managers have to deal with. And, I think the reality of it all is, and I've also written about this in terms of companies like Time Warner, and back in the day, in terms of trying to compete with Netflix and being a publicly traded company, and feeling that they were constrained in terms of chasing that opportunity if it meant years of financial stress. So it's a very real thing that impacts decision making. And you know, there's one solution in terms of what Warren is able to do with wholly owned subsidiaries. Not many of us have that option at our disposal. But there's also the option of being very, very selective about the people you partner with and the companies that you invest in, and that can greatly limit your investable universe. But to the extent that you think those things are very important to the long-term outcomes of a business, and to the extent that you intend on being a long-term owner of those businesses, it's the type of thing that you should certainly value highly, and you should also be pretty strict when you see things that seem to go against that desired outcome.
It's fascinating because if you do own a business over a long period of time, a couple of things will happen. One, the CEOs will come and go. I mean, it's very rare to find a company these days, maybe among some tech companies, when it's a young founder and they'll be around for 20 years. But they also phase out at some point, and they hire outside help. But you have to realize that business has to be good enough. And Buffett talks about it, that somebody not so competent could be running it for a period of time. Now, I'm being very polite with the words. I think Charlie was less polite with the words describing it. And then, yes, there are periods when somebody comes in and makes a great business even better. And it's a wonderful period, to participate in and observe and watch. And speaking of that, and it's no endorsement of Berkshire, everybody has to do their own research, but I'm thinking about the long-term success of Berkshire, and you talk about it in the book. What do you think makes this specific company different?
Well, I think you can surely start with, if we're talking about over decades, two people at the top, and probably most prominently one person at the top in terms of it being his full-time focus. And you just had very, very, very unique people and valuable people at the top, who then over time supplemented that with people like Ajit Jain and others who, again, were, I don't know if top 1% is even sufficient in terms of their capabilities, but also some of the managerial factors or qualities that we were talking about a moment ago. It's a fantastic starting point, right? I think you layer on top of that, rationality, patience, clarity on the opportunity set, something that Charlie mentioned specifically after Warren discusses the PetroChina investment. Warren says something like, I didn't do anything special on that investment. It was kind of common sense if you were reading the reports and yada, yada, yada. And Charlie says, when you were buying it, I didn't notice too many other people talking about it or buying it. Effectively, what you call common sense, I think, is more appropriately labeled uncommon sense. And it speaks to a clarity of focus in terms of what you're looking for and having the willingness to place, meaningful bets when those things arise. So I think that's a component of it. Again, remaining level-headed through extended stretches of, markets that may or may not be kind of working in your favor. Also being willing to updating your priors and to keep learning. Something that Charlie said nicely about Warren many times over the years as the number changed, right? As he became 75, 80, 85, 90, but how much Warren has learned in the last 5 years. He wouldn't have been nearly as successful as he is today if he had stopped learning when he was, 70 or some number like that. That sounds like an older person to a lot of us. So that speaks to something like, the IBM investment, which didn't work out well. And then the learnings from there, I'm sure, informed the Apple investment in a lot of ways, which more than made up for the IBM investment by a very wide margin. So I think you take all those things, and then I think finally you layer on what I mentioned earlier, the optionality that they had in terms of allocating capital. That in combination with patience allowed them to do things in private markets, public markets, etc. Now repurchases have become a more prominent part of that equation, but they've found ways to add a ton of value, and then once they were involved in the situations, they've also had some influence in terms of the incentives and the outcomes that have subsequently occurred. So yeah, I think like a lot of things in life, it's you look at someone like a Costco, why are they so successful? I think it's doing a lot of things really, really, really well and having a lot of clarity on what you're kind of optimizing for, and then doing that over and over and over again. And the over and over and over again part is, as you were hinting at a moment ago, that does become more difficult as time goes by, as people change, as incentives change. And that's how a lot of companies probably end up in a place where it no longer works.
There's so many things you bring up. The first one to me is trust. You trust the people that are running the business. And Munger talks about trust. These days we have those endless pages of legal contracts. Even if we move around, you go to a yoga class, you have to sign a waiver that's 7 pages. And maybe that's a way to go about it. Somebody pointed it out to me. I haven't thought about it, but it's true. But trust is this invisible bond where somebody will do the right thing no matter what the contract says. And I remember from your book and just Buffett and Munger's story how the initial purchases they made, they were on a single page without a room full of lawyers, and they did just fine. So the room full of lawyers will not save you if you're dealing with the wrong people. I think that's the lesson, right? The other side of it. You brought up incentives, and I've been thinking a lot about incentives, and I think it's a huge range that we think about and I think about. So if you want somebody to show up at 6 a.m. and open a bakery, you have to pay them a certain price per hour. If you want them to produce that many breads, you have to have some sort of a bonus structure. And if the bread has to be of certain quality, you have to have quality control and then bonus them on top of it. And they'll do amazing bread. But then you have a baker that comes in and he or she just loves making bread. It's their life. And I'm sure you've met people like that in all kinds of fields. And they'll show up at 5:30. And if it's their place, their heart is in it, their soul is in it. I talked to Vitaly Katzenelson about the idea of, soul in the game, which I find fascinating. And it doesn't really matter how much you pay them at some point. And Buffett continued to show up for himself and for all of us, for all the shareholders of Berkshire. Not because he had a bonus structure that incentivized that, right? And he definitely has more money than he will ever need. And he's now thinking about various ways of parting with it, giving it away. But you reach that kind of level of personal investment in what you're doing that money is no longer an incentive, which is fascinating because it feels like the whole investment profession is about money. But if the closer you look, you realize it's not. You're looking for people that are in it, not for the money. Isn't it fascinating how that works?
Absolutely. I mean, I think yeah, it is fascinating as part of this idea that I think people, a common, and I heard Brett talk about this on your podcast, right? Freedom, as Charlie Munger often talks about. And freedom is some ways financial, and it's reaching the point, you could say it's reaching the point where you have the flexibility to now do whatever you want. But there's also freedom in terms of doing what you love. And I think this is generally true that a lot of people find that they actually do get enjoyment out of running a business or working with people, whatever it may be. And there may still be some part of it that's financial in one way or another, but it's, as Warren always says about the companies they acquire, when they go acquire a business, in the vast majority of cases, that person now has the choice of whether they want to spend the rest of their life on the golf course or if they still want to keep, in your example, coming to the bakery at 6 in the morning, and they're looking for people who are doing it because they love what they're doing more than the check. They want they want them to care about the check, obviously, and that's, part of running a business as well. But it's a balance. And I think, there are probably professions or industries that are more tilted one way or another on this question of fulfillment and what work means to you and just the pure monetary attributes that it may offer. And those are industries that I'd say, generally speaking, they've tried to avoid more often than not. But yeah, it's like anything with, I think, assessing managers, which, to the extent that you're talking to people personally and in the capacity that Warren and Charlie have or did, maybe that's slightly easier. But I think you have some ability to do it too in public markets, I think. I mean, I look at, and I've said this for you, I think I've explicitly written this at times in the past. I look at someone like a Satya Nadella and at Microsoft, and you could tell me what his comp structure is, or you could focus a ton on what his comp structure is and talk about how that influences how he's running the company. I think I've listened to his words and I've seen what he's written, and I have a sense for who he is, and I'm very, very comfortable that, yes, I still want it to be a sensible compensation structure, something that's aligned with the interests of the owners. But also he has a broader vision and interest in the business and a, clarity of where he wants to go that in my mind has very, very little that's actually influenced by whether or not his nut at the end of it all is going to be 10% larger or smaller than it's likely to end up being anyways. And I think you can see that with some people more clearly than others. And again, you have to then, just like with business quality, if you're screening for a certain percentages of businesses that qualify as your opportunity set, I think that then influences how you then answer the question of how do I actually construct a portfolio? What does that then require in terms of position sizing, in terms of tinkering on adding and trimming to positions? That's all influenced by these factors that are interrelated.
Alex, I have a question about Mr. Market. We talked about volatility a little bit, but throughout the book, you bring up the topic of the market mood swings and how Berkshire navigates that. Can you share with us how that helped them in some ways, maybe find better opportunities?
Sure. I mean, I don't know how basic we want to go on what the concept of Mr. Market is, but essentially the idea is that there's a certain level of volatility in the markets that presents opportunities on either side of the equation. As Warren often does, and as we were discussing with someone like Peter Lynch, he always brings it back to the idea of, a stock ticker, a stock trading in the market is obviously a minority ownership in a business, and the way people think about the value of a business, if they were talking about the gas station down in the corner or, a farm or something like that, tends to be quite a bit different than how they think about the value of a stock, largely because of this little price that we now all pull up on our computers or on our phones every morning. And you can, I guess if you're doing Bitcoin or something, you can now track it even more so than 9 to 5 or whatever it is. So you can do it all the time. They then explain obviously that this liquidity, this constant price discovery should be a significant opportunity for the long-term owner, because you you choose when or when not to engage with Mr. Market, where you think his offer is, attractive one way or the other. Um, the 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 bad thing is that many people turn that advantage into a disadvantage by then reading too much into Mr. Market's opinion about the companies that they own and the companies that they've invested in, which, when you invest in a company on an individual basis, you're making a statement about your knowledge of that business that is reflective to the market's knowledge of the business. And then once you make that investment, you suddenly look to Mr. Market for answers as opposed to relying on the answers that you started with. So, that's the general idea of Mr. Market. And, they've obviously talked a lot about over time how they've navigated that. And, some prominent examples are, like Washington Post, where they bought it at a price that they thought was, I think Warren says, like a quarter of what he would deem kind of its fair value. And, it continued to face pressure after they bought it. And again, how he thought about it was this is becoming more attractive as opposed to, when you then layer on other things to Mr. Market like beta or other things that have been entered into the finance terminology or way of thinking about stocks over time, you get to some outcomes that are a bit nonsensical. So they run through all these things over the years of the meetings, which I outline in the book. But yeah, again, it's all in the context of thinking about ownership of a stock as ownership in a business and what that actually means, what you're actually buying.
To me, it's the idea that we operate in a certain context, right? So we find a business that we like, and we look at all the qualities that matter to us. And I think initially, in the early days, when people get into investing, or maybe that was me, you get excited, you just want to buy it today. I just discovered Coca-Cola, although it's been around for 100 some years, right? And no endorsement, of course. And the second part of the equation is the price you're going to pay. And the beauty of the stock market, the public market, that to me differs hugely from the private market, is that you have this anonymous crowd that comes in, shows up every day between the hours that you mentioned, 9:30 and 4. Maybe you can trade outside of those hours too. And they have emotions, they have feelings, they have different time horizons, and they vote every day. And you can agree or disagree with their vote. So that the beauty of it is that not only you buy a business that you love to own, that has high margins, high returns, whatever else you're looking for, and great prospects, but also in this market, now and then you can get it half off, which is pretty unique. Because if you have a privately held business, a mom and pop, 3 gas stations in town that are hugely successful, they have the right locations, and on and on and on. And you go to them and you say, I'll buy the whole thing, name the price. They have no incentive to sell. Probably they want to leave it to their kids. And if they do have an incentive to sell, you better really pay attention what the incentive is. Maybe a bigger chain is opening a location across all of the 3 they have. Or maybe some, Costco's opening with their lower price gas, on and on and on. You can come up with a reason. But if you have a private market seller that's super motivated to sell, you might not be an interested buyer. If you have a public market as such, motivated to sell, the reasons might have nothing to do with the fundamentals of the business. To me, that's the biggest part, and they obviously navigated that. Alex, I want to bring up inflation. We talked about interest rates, and Buffett wrote about inflation. Both in your book you bring it up, but over the years, I remember, especially in the 80s, he was always looking back at the 70s and kind of worried about inflation and explaining that it's a tax and so on and on and on. But can you talk about inflation, especially these days when we all experienced inflation more so in the last few years than in a long time?
Sure. Well, once again, I'll start with a quote from the book. This is from the 2003 meeting, page 349. This is Warren. Again, another short one. I won't make it too long. There's no question that a lack of inflation is a plus for owners. The real return from owning American business if purchased at similar prices will be higher if we have long periods of low or no inflation than if we have long periods of high inflation. Low inflation over any long period is better for investors. Inflation can swindle the equity investor, as I wrote back in 1977, and I use 7,000 words to explain why. It is the investor's enemy. So the tie-in then, as you kind of alluded to, is that then Warren had a period over, I think it's probably fair to say decades, where his track record on, maybe the word's not predicting, but just talking about what potentially could happen with inflation has been, as he admits, has been probably spotty at best, and it speaks to how to deal with these things, right, and how to how to take thoughts about them or an understanding of their impact, and then to let that thinking influence what you do or do not do in your portfolio. And I think we've seen, maybe not on inflation specifically, but on macro factors generally, very prominent examples as we record this now in January 2025 of people who have spent the last 10 or 15 years caught in some version of what I would call that trap. Generally smart people too, is my sense. They're people who they understand what they're talking about. They just become overwhelmed by or obsessed with thinking about things that, in my mind, you can play the game without thinking about. Again, as Charlie said, you can just take the waves as they come and ensure that you're able to navigate them. So how do you do that then? I think it influences the kind of companies that you own. And Warren and Charlie have talked about this in detail, and I highlighted in the book. You have, a business like a See's Candy where the volume growth in the business and the price that they charge for the product, they have an ability to weather that impact from inflation very well, given the working capital dynamics and the reinvestment dynamics of that business. There's businesses at the other end of the spectrum that are not well positioned to navigate that environment. In that case, a lot of money will be spent to basically stay in the same place, and obviously that's not a great outcome. So they discuss the different types of impacts that you have on businesses, but then they also bring it back to the individual and the idea of, when you talk about inflation, or if you talk about something like currencies, and think about, what is your best way to defend against those things changing. It's your own ability to generate income, basically. It's your own ability to be paid in the currency that is the currency that's used at that point in time, or the value of that currency in the point in time. I think I believe it's Charlie, says an example like, if you're the best surgeon in town, you will be fairly compensated, regardless of what the currency is or the value of said currency is. So, those are some ways to think about it in terms of how you balance concerns about it, or very real risks of it happening, with then actions in your investment portfolio or in your own life.
Inflation is this kind of a ghostly presence. It's almost invisible, but it has a huge impact. And the US was really spared the last few decades, and we could forget about it. And we can list all the reasons why inflation came down. And when it came back, I think it woke us up that it could happen. I think it can be very disturbing to businesses that are planning their investments, and they have inventory, and they don't get paid until later. Those things start to matter. When there are zero interest rates, a lot of those things, payables, and it doesn't really matter until interest rates go up, inflation shows up, and you start to think about it. You bring up pricing power, which is a very desirable quality. And it's something that you don't know you have. You kind of think you have until you test it. And we're seeing it with a lot of companies in the last, let's say, 5 years that are practicing this much more than probably in a long time, where they're raising prices on their offering. And I'm talking also about companies that we consider tech, and they're providing services online that don't have, physical expression, right? They're not things that you put on the shelf in the kitchen. And they are also raising prices. And then you can see who is successful. See's Candy, that you brought up, has been very successful raising prices over the years. So businesses can grow through volume and pricing. If they do have pricing power, that's usually beneficial. Alex, I want to ask you about something that's hidden at the end of the book. And I'd love you to give the audience just a flavor of what's at the end of the book. You talk about Berkshire as an insurance company, because let's not forget, it's an insurance company. And then, for the careful reader, and hopefully this audience they are careful readers, will make it all the way to the end of the book and find that chapter, which I really appreciated. But you share what it takes to run an insurance company, which Buffett makes it sound like it's an easy thing. I think it's a lot harder than he makes it look. But can you talk about that?
Yeah, I love this example. Well, first of all, I wrote about this at TSOH Investment Research, and it's the one article that I managed to get printed in the book as well, after some prodding on the publisher, because it's one I think is so important. And it's called The Right Way to Run an Insurance Company. And, to something that we were mentioning earlier, it's one of those examples that at least for me, if I had read about it 10 or definitely 20 years ago, it wouldn't have meant as much to me as it does now, reviewing the example and having a bit more understanding of what it actually means. And what it covers is something that Warren has talked about in the letters, but also at the meetings. It's the business trends at National Indemnity over the course of a 25-year period, called the early 1980s to the mid 2000s. And basically what happened is, in numbers, in 1980, the business was doing premium volumes of just shy of $100 million, and that declined over the next couple of years to about $60 million. Fast forward to 1986, and that number was around $360 million, so call it a six-fold increase. From 1986 to 1999, so nearly 15 years, that contracted from that roughly $360 million figure back to just north of $50 million. So, call it an 85% drawdown. Then from 1999 to 2004, it goes from 55 million to a more than 10x increase to roughly 600 million. And I lay all these numbers out in the book, and you can see them there, and you can read the article. But it leads to a really fascinating discussion around, one, what are the incentives of the owner of an insurance business, in this case National Indemnity, and how to deal with pricing throughout different market environments and when they do and do not want to write business. And then two, how to translate that to the incentives of the employees and what their interests are, specifically underwriting new business and keeping their jobs, having a reason to be kept around, which is very, very important to them, maybe more important than whether or not the company actually generates a profit, right? That's pretty understandable for anybody who's been an employee of a business before. So Warren runs through the example of how they explicitly told the employees that nobody would ever be let go of National Indemnity as a result of a lack of volume. Their concern was not the amount of business written, it was the quality of the business that was written. As I walk through in the numbers here, it's interesting to see, as Berkshire goes through, or as National Indemnity goes through all this volatility, what you see is they had an ability to basically hang in there during those lean years, which again was in a very extended period. Throughout that period in the 90s, almost 15 years, where they're effectively just kind of hanging on, making a small amount of money. What's really interesting is during those two periods where you see an explosion in written premiums, which reflects something that was happening in the end markets, obviously, their profitability on that written business was significantly larger than it had been in the earlier years. So obviously taken together, small amount of volume in a year, small amount of spread in terms of the margin, very significant volume in another year, very significant spread in terms of the margin. So obviously in terms of the dollars, you get to a place where the simple average profitability for the business over that time period meaningfully understates the actual profitability throughout that time period, because the volume and the rate together greatly influence the outcome. Warren explicitly says this too in discussing the situation, which is the overall track record is a good one. The interesting thing to think about is, well, one, could any public company ever replicate this outcome? Could they convince their shareholders or their owners or the street that this is the right strategy to pursue, as it's, let's say it's 1998 and you're coming back to people for year number 12 of, hey, the business contracted a little bit again this year, but this is the right thing to do. It'll turn eventually. You might not still be CEO if that was your sales pitch to the street. We also said, in terms of analyzing the quality of the business as a sensible outsider looking at it, how would you think about it at that point in 1999? It's a really, really hard question to kind of answer without having real clarity on what the business is, how the employees are compensated, what the actual long-term goals of the owners are, etc. And maybe just closing the discussion, Warren and Charlie go on to state, this is the right way to run an insurance business, but it's not the right way to run every business. You can imagine why this way of thinking is something that wouldn't work for an auto OEM or a bunch of other industries. And that in itself also is enlightening in terms of, for the answers to a lot of these questions, or for thinking about a lot of these questions, they're only relevant as long as you have context for the specific characteristics of a given industry or business. So anyways, it's a really fascinating example of something from Berkshire's history that just speaks to so many things that are unique about Berkshire and speaks to how they've created value over decades.
That's a great point. And insurance business is a fascinating business that highlights some of the points that apply to all the businesses. So quality over quantity, but here especially because it's not that hard to grow very quickly in insurance business and write a lot of policies that you will regret writing later. I guess it's the same for banking. You can give out loans that will never be paid off. So there are certain businesses where you say growth, sure, but what kind of growth? and you have to give it some thought. Alex, I have one last question for you. I'm curious about your definition of success.
Yes, well, that's a very deep question. I think there's, for me, there's probably two ways in particular that I think about it. There's kind of personal success, and it speaks to what I open with on here. I feel very fortunate to have had a great family my entire life, and there was nothing about my upbringing that was in any way basically influenced by financial considerations. Or I mean, we were okay, we were getting by, but the idea of being rich or caring about any of that stuff was never mattered at all. I mean, if anything, it was probably the opposite. And I as I now have a 10-month-old son, I'm obviously greatly interested in doing all that I can to try to ensure similar outcome for him, or something close to what I see as really fantastic childhood and a very happy life overall. And obviously the same goes for my wife and obviously my parents and sister still to this day. And balance with that is professional endeavors and business success. And it's in terms of TSOH investment research, obviously having it generate a sustainable level of income, which thankfully it's doing, for the book to sell well. Things like that matter. But there's other kind of outcomes that are probably even more important. People who subscribe to the service getting value from the work being high quality, like those things matter more to me, and I think they'll ultimately be reflected in the business outcomes anyways. Balancing those two things is the other part where success is a bit murky and honestly sometimes can be a bit difficult. I'm sure, like a lot of people you talk to, and as I've said, I became obsessed with this stuff, coming up on 20 years ago now, and also having a business that I'm completely in control of now as opposed to working for someone influences how often it's in the back of my mind and how I'm thinking about how I can do things better and how I can, be successful from a business perspective. So I have a ton of time flexibility as a result of running my own thing, which is fantastic, and I do my best to take advantage of. But it also is something where you think about things a bit more than if you're someone who's going into a job and getting paid a salary, and that's a very well-defined thing, versus I don't know what my compensation is going to be 6 months from now, so I have to think about it and worry about it a little bit more. So that's something where, at least for me personally, particularly this day and age with technology and things like that, is something I personally have to spend a lot of time monitoring and making sure that I'm keeping those things in a thoughtful balance, which hopefully I do a decent job at over time. And if I don't, my wife will let me know, I'm sure. But yeah, it's balancing professional and personal success, and yeah.
I can tell that you love what you do and you have a lot of fun with it. And it's something that I can relate to, that I got into investing not for the money. I found it as a fascinating intellectual pursuit, especially the kind of work I get to do with the families I work with and managing portfolios for them. And yes, I do get compensated, but that's not what gets me up in front of that bakery at 5 a.m. That's not. I love making the bread. I love the process, and I love what it all means to the clients I work with and what kind of difference I can make. And money kind of follows that, but it's not about the money. And I'll bring it up that to me, the fascinating observation from so many conversations I've had, and I think I'm coming up on 150 or so, is that people that stayed in investing didn't come here for the money. They came for much more than that. And they found purpose, meaning, and other aspects in it. And money kind of followed. And I think it's really a lesson there that if you come here just for the money, you might not stick around long enough to see the results of what this pursuit can do for you, both intellectually and even, people you get to meet and things you can learn, and on and on and on. But I think there's a huge lesson behind it. Alex, thank you so much for today. Wonderful book, Buffett and Munger Unscripted. I highly recommend it to people that know both of them inside out and people that are just getting to know them. Thank you so much for today. What a pleasure to have you on the show.
No, thank you for having me. I told you before we started recording that I enjoy doing all podcasts, but I was very excited for this one because I know there was a certain style of question and conversation that you wanted to have based on my listening to your prior podcast that I knew it would be a fascinating discussion, and I think we lived up to that test. So I had a great time. Thank you for having me.
I really appreciate that. Thank you so much. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.